everyone. We will now move into our second session, and I'm pleased to introduce Jennifer Quisenberry. Jennifer is the Chief Investment Officer at NIAM and leads the firm's Investment Policy Committee. She is responsible for oversight of the fixed income and equity trading, research, and investment operations. She joined the firm in 2007 and prior to her current position, served as head of structured securities. Before joining NIAM, she was head of structured research at Conning Asset Management and a managing director at Structured Finance Advisors. Jennifer holds a BA in Economics and Finance from McGill University and has an MBA in Finance from New York University and is a CFA charter holder. She has been employed in the investment industry since 1986. Jennifer, thank you for joining us, and I'll turn it over to you.
Thank you very much. Just confirming that you can see the slide deck in front of you. Very good. Thank you very much. Good afternoon, everyone. It's wonderful to be speaking with you today. We have a lot to talk about on the U.S. Economic Outlook page here. I'm sorry, can you see the slide? I don't see it on my screen, which is a bit confusing.
We can see the first page.
Okay, very good. All right, very good. Thank you. So let's get started here. I like to start these things at the very top when we talk about the economic overview. And I think the best way to think about it is that from the global, or rather the U.S. Overall GDP view. And what we're looking at here is what that GDP looks like these days and how that has been trending. I've got a few things to look at on this page. A lot of these charts are somewhat dense, but I figure this audience can handle that. I'm quite sure. But what we're looking at is quarterly GDP, and what we can see is there's been a lot of volatility. We've got a lot of contributions, both positive and negative, and we can zoom out and look at, what does that mean for the overall economy? And I highlight that in two frames here. One is the, total GDP number. That's the number that seems to be moving quite a bit, as well as what we call the underlying domestic demand, and that's the gray dashed line. So, what is this chart showing us? We've seen a lot of volatility again from imports and exports. We had the tariff effect last year being imposed. We had a lot of pull forward of orders. We had recovery of that in the following quarter. And we've had, government spending reduced as a result of some of the cost-cutting measures there. But what sticks out from this chart is what have been the growth drivers of the economy. And those really have been twofold. One has been the consumer, which tends to be a kind of a stalwart of growth in the U.S., the personal consumption component. And we've also seen fixed investment, but in particular, in this section here in the blue, that's the fixed investment excluding residential. So what that is this big AI boost that we are seeing coming through in the economy and spending in that arena. So how significant is this spending? Well, it is quite enormous. As we look at the hyperscalers planned expenditures in the coming years, it has been just skyrocketing and ballooning extraordinarily. And in fact, this year that expected spending on CapEx for those hyperscalers is expected to be about $650 billion or so. So just to put that into context, that is equal to the size of the GDP for Sweden or Singapore or Argentina. And it is also about equal to the combined military spending of Germany, France, UK, Japan, Italy, and Canada put together in a full year. So that gives you a sense of just the magnitude of this spending that is happening to support this AI boost, which is also, of course, giving huge support to the economy as well. So how will all of that financing be, or how will all of that spending be financed? Well, that is going to put pressure on the capital markets and where that will be placed. Now, typically, capital expenditures are funded through cash flow or operating cash flow of companies. So typically, they're just taking that cash flow and reinvesting it back in the business. Obviously, this amount of of spending is going to require well above that. So, if you put a big lens around it, it looks like about half of the source of funding will be coming from that cash flow, and the other half will be coming from the capital markets, either through equity issuance or debt issuance. We think a lot about the equity, I'm sorry, the bond or the debt component of that spending, because those can create pressure points that can cause valuations to reprice. In other words, spreads to widen when there's a lot of supply that needs to be absorbed. So the expectation, though, is that a good amount of this spending will be financed through private credit. You've been hearing a lot about that, as well as from the traditional capital markets in both investment grade and non-investment grade, as well as securitized and other capital as well. So takeaway here is that this is going to be quite an event for capital markets, and we're going to be seeing more of that as we see these equity raising programs, whether it was the 85 billion that Google Alphabet was raising last week, and on to Anthropic and OpenAI expected to do their IPOs very shortly. So let's just talk briefly about the other component of the GDP that is growing, and that is personal consumption. But an interesting observation that we are seeing in the economy is how that spending, or where that spending is coming from. And what this chart is showing, that increasingly the top 20% of income earners in the United States are taking up a larger portion of both income, of income, of net worth, and also of consumption being at the highest level that it is or ever has been for that top 20%. So this is quite an interesting phenomena. It's not new. It's always been that case, not to the same extent as it is now. But the implications for that are a fewfold here. One is that because the upper end consumer has those buffers, has wealth in the equity market, in their assets, and also in their homes, they are in a better position to absorb a lot of that spending and have the buffers to do that. So that is really where this is coming from. But also, it explains in part why, as we are seeing these very high levels of consumption in the upper income consumer and very low business or consumer sentiment, rather, it is because it is the upper end of the consumer that's pulling that through. So we can have, I guess, both existing at the same time. We have low consumer confidence, but we have strong spending because, again, of the upper income consumer. We're also seeing some stresses coming through the pipeline here as we look at, for example, savings rate in the United States. And this, we can say, is part and parcel of what is happening with the spike in gas prices, where consumers are feeling that they have to dip into that more of their disposable income to fund those higher price gasoline purchases now. And that's not dissimilar to what we saw back in 2022 at the outbreak of the Ukraine war, same kind of pull down in consumer savings. Now, it was expected that some of those tax changes with the OBBBA, the One Big Beautiful Bill Act, would be helping the consumer to offset some of this. But those increased refunds, those tax changes have only offset, well, about 25% or so of the increase in gas prices. So that's why we're seeing these effects on the household savings rate. So let's just talk a bit about inflation. Obviously, this is a key topic, a key uncertainty in the economy right now in terms of where this is really going to go. So I've got a bit of a spaghetti chart here to show some of those components of inflation, also called the CPI, or Consumer Price Index, to kind of break down what is happening here. And we, again, see a lot of different lines going in different directions. I'll point out just, the headline CPI, that's the dark blue line, that is including really the entire consumption basket as defined by the Bureau of Labor Statistics. But we also look at something called, core CPI, which is what you get when you strip out food and energy, which are traditionally very volatile components of that index. A little hard to see in this chart, but what is happening is that the CPI headline number is spiking up pretty dramatically. Oh, it's up about 1% or pardon me, a percentage point. So from basically 3% to 4% on a year-over-year basis, whereas that core component is only up about 0.3%. So it's really as a function of those energy prices and food to a much lesser extent as well. And you can see that energy, that's the gold line spiking up very dramatically here. On the other hand, we have seen some components of inflation falling. Shelter, believe it or not, housing, because of the pass through of lower rents, which is used to compute the broader housing inflation index, have actually been coming down. So the takeaway here is that though near term inflation is rising pretty substantially with energy, there are other components of inflation, housing, also, some of the other what we call core services have been coming down as well. So there have been, prior to this conflict in Iran, there had been forces that had been bringing inflation down, though somewhat sticky, and now those forces are moving into reverse, of course, with the situation in Iran. Now, the Federal Reserve is very focused on what markets are thinking about inflation, what consumers are thinking about inflation, and they have a number of ways to look at that. This is just one measure that is a market-based measure called inflation swaps. So what this is showing is what are expectations for inflations moving out into, over the next year, 2 years, 5 years, and 10 years. What is the market's expectation for what inflation will be? What this clearly shows is that the 1 year outlook for inflation expectations are quite dramatically higher at over 3.5% over the next year. But as we move further out to 2 years, 5 years, and even 10 years, you can see that that inflation thrust really isn't there in any meaningful degree. So in other words, short-term inflation expectations very elevated, longer-term expectations are relatively sustained or sustained at a low level, I should say. And again, this matters for the Fed to the degree that if they see longer-term expectations becoming embedded and in the system, in the economy, that gives them a great deal of concern because those inflation expectations can build on themselves. They become something of a self-fulfilling prophecy. If companies and firms, for example, expect prices to continue to be rising, they will continue to price their goods higher, as well as wages would follow a similar concept or philosophy, if you will. So this is a really relatively good state of affairs in terms of the inflation outlook. Yes, very elevated in the short term, but as we look out a little bit further, it looks like they would be potentially more subdued, which is relatively good news, though not completely. When we talk about the Fed, we'll talk about that more in just a minute. So the U.S. economy has historically been very sensitive to these oil shocks, and in several cases, they have led to recession. So that's what this chart is showing, both the recessions shaded in gray areas, the nominal oil price, which is in the green line, and then the oil price adjusted for inflation, or the real oil price in blue. So if we're going to be making comparisons of today's oil price versus past oil prices, we really need to put that in the context of a inflation equivalent oil price, if you will, and that's what the blue line is doing. So what we see here is that we have certainly had very significant spikes and recession following those. And what you see here is that today's gas price, though it is elevated, it is not near the scale of what we have seen historically. And certainly we can even look at a period such as 2011 to 2014 when the real price of oil was quite a bit higher, and we proceeded without a recession during that period of time. So what this goes to is that the U.S. economy really is much less sensitive to oil price shocks than it has been in the past. And that is due to a number of things. One is that the U.S. is now oil independent. We are actually exporting more oil than we are importing. We still do import some oil, and we need that for certain processes and certain grades of oil, for example. But we have made great strides in terms of shale production, renewables, nuclear, and so forth. So we are, on the face of it, actually energy independent, which puts us in a much better position, especially as compared to Europe or East Asia in particular. We are a less energy intensive country. We are using a lot less gasoline. If you even consider the amount of gasoline that is, rather consumed by the consumer, historically it was, closer to 6 to 7% of the consumer basket. Now it's less than 3% of the consumer basket. So we are consuming less oil as well as other processes that have improved, and we're consuming less energy. We have a smaller manufacturing footprint that again has gone from, call it 20% in the 70s to more like 12% today. So we're not engaged in the energy intensive active manufacturing to the same degree, and just improve inventory management in terms of supply chains and just in time inventory and all of those things also helping to manage the supply and demand of oil. So overall it looks like a relatively benign picture relative to history at this stage. However, if the Strait of Hormuz doesn't open in fairly short order, we could be looking at a very different outcome. There have been estimates pointing to the end of June when the operational supplies of oil, that is the levels of oil to keep things moving, to a degree required or have the enough oil in the system to allow that to happen. And I'm not speaking to the U.S. now, really more on a global basis, is getting to be quite low. And then by, call it, September, Labor Day or so, they reach very critical levels, and there will be larger shortages and shortfalls throughout the globe, which is where oil prices are ultimately set, which do flow through to the United States. So it is at this point we are managing through this, but certainly it is at risk of becoming more of a dangerous situation if we proceed much further from this point. So this has been a lot of bad news, I feel. So to turn the page on, I think some more positive indications in the economy. Yes, we talked about how the growth in GDP at a macro level is strong. Corporate profit margins are definitely another bright spot for the U.S. economy. Here you can see we're seeing basically the highest levels of corporate profit margins ever outside of some brief periods during the pandemic episode. So it is strong corporate earnings. Corporations are doing well in spite of tariffs, in spite of energy price shocks and so forth. And this is expected to continue with earnings per share estimates anywhere from 15 to 23% next year, continued growing in that fashion. And I would just say really demonstrating and reflecting the dynamism, the access to capital that is unique to the U.S., flexibility of resources, really, for the U.S. economy. Another bright spot I would point to is just the degree to which there is leverage or over leverage in the system. That is a situation that marked the global financial crisis back in 2007 to 2009 time period. We can see here that, financial leverage at that point in time, household leverage was elevated here in the blue line. So at this point, we've seen those metrics of overall leverage and debt in the system coming down, though we have seen public sector financial debt, of course, of the U.S. government rising, which is certainly another challenge for the U.S. economy longer term. So as we kind of wrap up this first section, just looking at some of the overall takeaways, certainly, an uncertain situation here with the geopolitical events, with the oil price spikes and the end to this conflict, or at least movement of oil through the Strait of Hormuz, are really, in our mind, increasing the range of outcomes. We'll talk a little bit more about the capital markets implications of that. Growth concentration in both the AI spend sector and the consumer upper end consumer sector are also notable in terms of kind of a shift or observation. Inflation is fairly noisy in the near term, expected to be more subdued in the longer term. And then strong credit fundamentals when we look at earnings, when we look at leverage in the system, and overall looking pretty good. So just as a setup for the economy, we'll leave it at that. So I wanted to just delve into another very big topic for the US economy and for the future of the US economy, revolving around the labor market. What is happening in AI thus far? What can we observe? What can we see? And from an economic perspective, what does that mean for productivity, which is really the promise, I will say, of productivity. This is the positive outcome that is hoped for by many, and it has certainly very strong benefits to the economy. But first, let's just take a quick look at I'd say a fundamental driver in the labor force, or a fundamental observation that is very important to keep in the back of the mind, which is that from a perspective of population growth, the U.S. economy is slowing very significantly. It is slowing because we have tight restrictions on immigration, and we have an aging labor force. So, from the perspective of population growth leading to labor force growth, obviously that means that the labor force is facing those same headwinds in terms of how it is growing or not. In this case, not growing. So this is some data taken from the Federal Reserve, which kind of paints this in very stark colors and trends. Which is, if we break down the population contribution and we break down the contribution of labor force participation change, to look at the kind of whole, what are the factors that are changing the labor force itself? That's depicted in the red line, and we see that according to this study, in 2026, it could be flat, which is a pretty negative outcome for the U.S. We haven't seen that before, and when you consider that the labor force has been growing, or population rather, has been growing at about 1.6% per year, and we hit a number that is flat, that has huge implications for the broader economy and for jobs and for the labor market, which is the engine of the economy, with personal consumption making up about 2/3 of the overall spending in the U.S. economy and contribution to growth. So what we've been observing is some changes in the rate of change in job creation, and this is really just more a function of what are firms adding to the labor force through hiring, through firing, and what is the net change in the number of people working. So that's non-farm payrolls, and here we're looking at the monthly change in the blue bars and the 3-month average in the green line. And what this is showing, first of all, is again another series with a lot of volatility, a lot of movement around it, much of which I would attribute to the tariff volatility from last year, the policy uncertainty. I think firms were very much wondering what's coming next, how are we going to deal with these challenges, and not really sure what that meant for the future of their firms and therefore for hiring. So it would seem to reason that we were seeing that kind of volatility in the last year. But we've seemed to have got through a lot of that, as we saw in the GDP growth. Economy still grew through those periods for the most part, and now we're seeing a return or a reversal in that trend, that 3-month trend, that green line, which had even turned negative during last, call it third, fourth quarter, is now turning positive once again with with the changes in I would say, yes, business certainty, but also a need for hiring that had been put on hold, if you will. One other interesting trend that we saw in terms of the jobs that were created was that they were very much centered in healthcare and social assistance, healthcare in particular. That makes sense. We have an aging economy, or an aging workforce, and an aging population. But in the most recent payroll report just last Friday, we saw the job creation across sector broadening out, which is a very good indication, because that points to not just those healthcare jobs that are affecting the non-farm payrolls, but something more broader, definitely more indicative and reflective of the kinds of things we were looking at when we saw the corporate earnings boosts, and also the AI spend as well. So what we also have seen is some of the changes coming through in productivity. Productivity is just a measure of the output or GDP creation for per worker or per resource in worker. So basically, that's just how much are we doing with the number of people who are working. And what we see here is that we are seeing an uplift in productivity. We are seeing something, of course, the big productivity boost came in the 1990s when we were seeing the broad acceptance and proliferation of the personal computer and the productivity gains that that brought. And we, potentially could be seeing those kinds of similar vein here that is happening now. You see in the pandemic period here around 2020, we had definitely a spike in productivity. That is really marked by, we had a lot of people leaving the workforce at that time. You're dropping out of the labor force. So, because we were doing more with fewer people, we were actually boosting productivity as a function of that. So that's a little bit of an outlier, but those improvements have certainly carried through. So, we would say that, the AI technology changes are beginning to come through. That's really very much still at early changes. But another function or aftermath of the pandemic is we had very high levels of business formation, and that was another productivity booster. And we've, of course, had a very flexible workforce and improved worker skills adding to that as well. So I would just say it's early to be attributing all of these gains or these gains so far in productivity to AI, because it just seems that we're in early stages with that. And this is some evidence of that as we look at the adoption rates or how AI is really moving through the system here and how we are making those strides and who or what types of firms are doing that. So I like these charts. This is taken from McKinsey because it gives a scale. We say, are you using AI? Well, yes. Well, what does that mean? Are you fully scaled? Is it fully integrated in your operation, or is this something you're kind of experimenting with within your organization? And of course, there's a full range of that. And the chart on the right is giving some evidence of that in terms of where are we seeing those effects. Clearly in technology, we see the greatest level of uptake. Looks like insurance is doing pretty well here in terms of its usage in marketing and sales, IT, knowledge management, risk, legal and compliance as well, and it's kind of scattered throughout. So, as we pull back, and I guess I would just point to another study. This is from the U.S. government, which has said that basically, and this is the headline here, the AI adoption overall is estimated at 18%. So, I guess I would take that away to say, yes, we're at early stages of AI. We are seeing more, pardon me, I think I'm getting a message here on my screen. We are getting we are seeing, that yes, the early stages, but it is by no means completely widespread, and we are still on that path of AI adoption. So, there's a familiar, I guess, adage or story or metaphor, I guess, about the horse and the tractor. And, here we have, Farmer John talking to the horse here, you saying, you won't lose your job to a tractor, it goes, but to a horse who learns how to drive a tractor. And again, this is something of a metaphor for what does AI really mean for the worker? And does this mean that they are indeed replaced, or alternatively, is their job augmented? Do their skills enable them, or this assistance with some part of their job assist them in augmenting or growing and become a more productive worker in other ways, and frankly, with a better job? So we can look at one example of this, and that is automated teller machines during the adoption in the 80s, 90s, and into 2000 in terms of the installation of ATMs and what that meant for tellers, in fact. And so what happened here is that ATMs, of course, became broadly available and installed across the country in meaningful numbers over time, over really was quite a long period of time as we look across 2 decades. But what happened was the banks were finding that these indeed did improve their operating margins at the bank branches and enabled those banks to open more branches for which they needed more tellers. So what happened, in fact, was here we see on the blue line is that the number of jobs of tellers stayed pretty stable. In fact, even as these ATMs were employed, what happened to those tellers? Well, some of those routine deposit taking, cash withdrawal, and so forth were done by the ATM, where the teller could focus more on those value added services and relationship banking and those kinds of things to support the bank operation as well. So, it's one way that we can think about how AI could be improving both the productivity of the worker, the job skills, potentially the pay, and again, their resources as a result of that. So this is again, I guess what I would go back to the word, promise of AI is that it could potentially bring all of these things, to the table in terms of that benefit and productivity being one of them. So, that's kind of a story, a potential story. I'd say it's a pretty optimistic view on AI. And going back to that first chart on the labor market and the decrease in the number of workers available because of both population and immigration, it becomes ever the more critical that productivity can be an offset or it help to alleviate that situation. In other words, if you have fewer workers, but you have higher productivity, then you can still reach the same or greater amount of output for the economy. So it is perhaps very coincidental and serendipitous that these things could be happening at the same time where productivity is in need because of the what is happening in the labor market overall. Other takeaways are that we simply are at the very early stages of this. Clearly, that is going to be broadening and increasing over time. And certainly along the way, there may be some labor disruptions or in certain sectors specifically, but the positive upskilling of workers, career advancement, higher salaries, and all of those benefits that it brings to the economy are quite positive in terms of, again, that growth, increased productivity itself. That also means lower inflation, which is another positive for the economy as well. So that's kind of the story on AI as I see it. So let's jump into capital markets outlook, and this is the last section of the presentation, and that's where I live in my day-to-day world is the markets and what they are doing, what that means for insurance investor portfolios, especially for the bond market, and what that means for the Fed. So that is there's a lot going on there today, and let's just kind of jump into what that is. Well, first of all, what we can say is that we've had a bout of volatility when it comes to interest rates this year. Here I'm showing the year-to-date change in yields across the Treasury curve, going from 2 years in the dark blue. Today, year-to-date, that's up about 70 basis points, a little bit more than you see here in the chart that was taken just a few days ago. The 5-year up about 56 basis points, the 10-year about 40 basis points or so. Again, this is for today, and then that 30-year to a lower degree year to date, it's up about 20 basis points. So we have talked a little bit about the inflation implications here and what the market is thinking about inflation. We talked about the fact that that is more of a near-term effect, that the inflation expectations of the market are more for the next 1 to 2 years, but not out to 10 years, for instance. So the 2-year yield jumping to the degree now of about 70 basis points very much reflects that inflation pass-through or that inflation view. So that CPI chart, if you remember, was up about 1 percentage point, so 3 to 4%. The 2-year up about 70 basis points. So that's directly implicating what the 2-year expectation going forward is. That is very much saying what the market expects the Fed is going to do. Basically, what they expect the Fed to do is to raise interest rates. So that is very much what's happening in the 2-year and the short end of the curve. In the longer end of the part of the curve, though, it does not appear that inflation is having those same effects and forces. What is happening, or I'd say other concerns about the long-term part of the yield curve, that has more to do with the federal debt and deficit dynamics. that investors need to be compensated more to take on that longer term risk to the degree that we could be having these larger deficits, which put pressure on long end yields due to the fact of the amount of debt that has to be issued and undertaken by the market. So it's a bit of a demand and supply story there. The other component that appears to be driving the long end is the expectation that AI is going to lead to ever more growth. Now, we talked about, again, the productivity improvement for that, that's growth supportive. So the idea that the AI boom could be bringing greater growth is, again, inflationary, potentially to the longer end. So there are really, in my mind, a few things going on in the longer end of the curve than necessarily in the short or immediate part of the curve. When we turn to equities, we again see the story around that concentration in terms of, it was the AI and the consumption in the GDP. Here we see it's year to date, all about energy and information technology. That's all the AI spend. And again, the optimism and the expectation that these firms that are achieving very strong revenues and operating margins, but still there's an expectation that they'll be able to continue to do that, reporting period after reporting period. Broadcom last week released very, very strong earnings in revenue and operating profit. In fact, they beat their expectations, but their earnings outlook for the coming quarter and year fell a little bit short of those expectations for the future. So it's not just what you've done for me lately, it's what you are going to do for me in the future, and the consistency of that. So really the story for returns thus far, this is again taking a couple of days ago, 11% year to date on the S&P 500, very much attributable to, again, energy is having a big day with the conflict in Iran, but it's really mostly due to information technology and that story developing in the equity market. So back to the Fed and what we are seeing here in terms of that expectation from markets is that the markets are expecting that the Fed is going to be hiking rates later this year. So what I've got here on this chart is the number of cuts or hikes that are priced into, again, these expectations. If you are the betting markets for interest rates, that is typically defined as a 25 basis point move is equal to a hike or a cut. So as we look toward the end of this year and into next year, it looks like the markets is expecting that we're going to get 1.75 of those percentage points of hikes, or 1.75 hikes, in other words, 1.75% of hikes, which would bring the Fed funds rate well into the 4% territory from about 3.6% territory today. So this again is this expectation that inflation in the market's view is going to continue to be persistent because of the oil shock and the potential that these oil shocks, the immediate oil shock, is going to be feeding into other what we call secondary effects. That means further into transportation, that means further into fertilizers and therefore food. There is also inflation that is arising from the AI spend, putting pressure on those computer servers, semiconductor chips, and all of the components that are that big $646 billion of spending that's happening as well. So there are certainly those drivers of inflation they're leading to this expectation. However, thinking back to that other chart showing some of the aspects or elements of inflation that are actually declining and easing, possibility that we won't fully get those rate hikes in the coming year because of if we indeed do move past this period of elevated energy inflation, that we can begin to see those forces reassert themselves. In my personal view, I think we could see that the market is overextended a bit here, that this may be overpriced. In other words, we won't get a full, close to 25 basis points hikes, that we may get something more than that, or we may get nothing. In fact, because some are of the view that the Federal Reserve policy rate is already somewhat restricted. In other words, it's pretty tight. Although with this kind of growth that we're seeing, it's increasingly difficult to see that. So, this is really a push-pull of many factors when we talk about that expectation for Fed funds. It's partly, yes, it's an expectation for inflation, it's an expectation for growth, and it's a real pulling forward from the current experience that we're seeing today in the markets being projected forward, which is why the markets sometimes overshoot in either direction when they make these assessments, for example, here in the Fed funds futures rate. So getting back to kind of day to day, what we do and what we think about is primarily bond investors, and of course, most insurance company portfolios are focused on bonds. It is really a very positive backdrop in terms of all in corporate and structured and even treasury bond yields today. And that's what this chart is showing and bringing to the fore in terms of what that really means and what that opportunity is. So here I'm showing basically historical ranges over the past 10 years for all in yields across a number of high quality bond sectors that you would be seeing in your portfolios, from the aggregate bond index, which is about 40% treasury bonds or so, all the way to investment grade corporates. We have some of the structured sectors, mortgage-backed securities, asset-backed securities, some more what we call non-core CLOs or non-core ABS as well, non-agency residential mortgage-backed securities along with CMBS securities, and then some of the municipals, both tax equivalent and taxable municipal bond yields. So we look at in the gray areas, you're looking at the ranges over the past 10 years, and you can see those very low watermarks here in these lower levels, 1-2% yields when we were moving it beyond the pandemic, and even before the pandemic period, very, very low yields. Some of those peak areas we've seen very high yields. The average over that 10-year period in the teal slash here, and this is where current yields stand, clearly into the 5%, getting towards 6% range in some of these even very high quality non-agency residential mortgage-backed security type opportunities. So this is all to say that this is a very positive backdrop for the bond market and for insurance company investors to be reversing those very low levels of book yields, and to be reaching very attractive pre-tax book yields from the bond market right now. Now the when we look at the comparison between bonds and equity earning yields, for instance, what you're seeing is really a compression of that, which is to say that with equity valuations fairly high and bond yields rising, it is becoming increasingly attractive to put your money in bond yields. And that is causing strong demand for bonds that we are seeing across the landscape as well. But in spite of that, we still have very attractive all-in yields. Again, these current yields in the gold squares are very interesting and attractive for fixed income investors now. So in terms of those capital market conclusions, overall, it is a very optimistic and positive tone. I would say from the standpoint of recession risks, fairly low. I'd say 30% or less. From the standpoint of the growth outlook and the positive aspects of AI and what that could be bringing to the market in terms of productivity, in terms of growth, and really a very again strong demand and tone and higher yields are certainly a strong backdrop for the markets. Treasury yields higher across the curve. Longer term, we think a lot about what that means for, or the implications for, federal debt. As interest rates have been increasing, that means that the federal debt load is increasing. Federal interest expenses about $1 trillion more than what we're spending in defense spending at the moment. But that is certainly a negative for the federal debt and rising deficits. And one concern is that those levels of rates are rising because of that concern, and will become a greater concern, I would say. But certainly, leaving it today, it's a very opportunity rich environment for insurance companies in core fixed income, and the opportunity to earn those attractive yields in this again very optimistic environment from an economic backdrop as well. So I'll leave it there with my prepared comments and slides, and happy to take any questions.
Linda, would you like to read the questions?
I can do that.
Okay, I'll leave that to you.
Yeah. So the first question is, does it make sense for the Fed and industry analysts to focus on core PCE when average consumers are burdened by the fuel and food costs that are excluded and seem to be politically enraged by the parts being carved out in the core CPE?
Yeah. So the thinking behind the use of core PCE is that it is more stable, and the segments that it's excluding are routinely, just referred to as the variable or volatile aspects of inflation. So it is, yes, it's a very good point, because those are the day-to-day expenses that people are focusing on, are certainly those high gas prices, high food prices, and not just today, but it's been like this since the pandemic. So prices cumulatively are up nearly 30% overall if you look at the CPI index itself. So it really is painting that picture. The problem, however, with focusing on something like the energy shock is that monetary policy really isn't equipped to handle supply shocks. So the way that monetary policy works is on the demand side. So by raising rates, the idea is to bring down demand so as to slow down the economy and to bring things into better supply and demand into better balance, broadly speaking. So the argument is that the Fed will not be effective in dealing with, if you will, supply shocks. As you know, there is now a new Fed chair, Kevin Warsh, and he has taken the view going the other way, that not only should we look at core PCE, but we should exclude the variable kind of tails. Actuaries will understand this, like the top and lower tails of the distribution would be eliminated, so that you could get a better focus on what that core level of price level inflation is, which is again going in the other direction. So I completely understand that question, and it is not really helpful to the consumer to say, even though core PCE today is about 3%, but the price at the pump is up by 35%. So they're not comforted to know that the core PCE, that has no bearing on my day-to-day life. So that's the theory behind it. One, to just avoid those very volatile periods by focusing on a measure that is volatile, and two, it's really meant for more demand side management than supply side shocks.
Thank you. The next question is definitely a hard one. If Democrats retake both the House and the Senate in the midterms, will they be able to end the tariff and or other inflationary policies coming from the executive branch?
So here's the thing with the tariffs. When the OBBA, so the most recent tax act, was put into place, that had the effect of extending the tax cuts from 2017, which was very much expected that we were going to. Now, the tax cuts that were done in 2017 were only for a limited period of time, so they didn't have the effect on the budget deficit because they were assumed to expire. But of course, they were going to be extended for all intents and purposes. So that had to be paid for. In addition, there were other changes in the tax code, pluses and minuses, but the big part of it was definitely those tax cuts. The way that the Trump administration addressed that was to assume, along with assumptions about what interest rates would be and what the growth of the economy would be, and this is more technically the CBO who does these calculations, but the tariffs went a long way towards basically offsetting those tax cuts. So, so from a pure fiscal standpoint, that was crucially important to getting the OBBA passed, which was they could say that we've kind of offset that, and indeed in some scenarios, I think they even had the deficit falling. But be that as it may, that clearly is not happening. So I guess what I'm saying is that we're a little bit stuck in terms of the impact on the deficit from the tariffs. So when there were various tariffs that were put into place during the Biden administration, or rather, I'm sorry, the first Trump administration, that the Biden administration just kept because they otherwise would have lost that revenue. Now, it wasn't a large amount of revenue that it is with today's tariffs, and tariffs are a whole other story to get into. But my point basically is that it's generating revenue, and that's very important for the economy, for the deficit rather. So what I would say about tariffs is that, one, they have been pretty much baked in, or we've been living with them for almost a year now. It's been up and down and back and forth, and some of the tariffs were removed, and now they're being replaced with something else. All of that. My point is simply that it's been somewhat absorbed into the system, somewhat by firms and obviously by consumers as well, but not by exporters from other nations. By the way, they really have not been affected. So it clearly has had an impact on price levels. I'm skeptical that a new administration would just get rid of them because of the deficit impact, is really what the answer is. So while beyond just the pure revenue part of tariffs, it clearly it's very protectionist, and it has definitely affected our relationships with trading partners, Canada and Mexico included, some of our closest trading partners and relationships. But that said, there are a lot of tentacles to this tariff argument, obviously. But I guess I would just say that it will potentially be very difficult when all of the numbers are put in the pot to try to figure the deficit situation or the fiscal budget for the following year. If you get rid of tariffs, that's hundreds of billions of dollars less that you don't have any longer. So I think my personal opinion is that it would be difficult to pull it back. And though it is certainly having an effect on consumers, the the deficit is also another consideration that really paints politicians in a box, and that is unfortunately the unfortunate reality, which is that it comes down to what then you can afford to do. So that would be my interpretation of that.
Thank you. And we also have a follow-up question. So if the Hormuz infrastructure is damaged to the point that supply is unpacked through 2030, as shown in the oil futures prices, what can help this supply side shift if the Fed doesn't have the two?
Yeah, so there definitely will be longer term disruptions in the strait, or there's been production that has been destroyed. There obviously are now real questions about the strait as well. So it's not just a problem for when we get through this near term problem, and potentially it gets much worse. But I think there's the trust in the oil coming through the strait has been shattered to a large degree. When that happens, there will be other outlets, and what that means is even in the U.S. increasing production, in Venezuela is bolstering production. Other parts of the world, Africa are increasing production. OPEC is increasing production, presumably other ways that they can get the oil out than through the Strait of Hormuz. But there tends to be other outlets that would potentially arise in the world as that happens. If the price of oil remains elevated and if energy companies are confident that that will continue, then they will be willing to invest in bringing that oil out of the ground and refining it. So it becomes a bit of moving the deck chairs around a bit in my simple view of how this could potentially look. That though the Strait of Hormuz brings 10% of oil and 20% of overall energy, that over time the oil industry becomes less dependent on the strait and it filters in other areas. So that is, I think, a potential outcome to that. And again, on the demand side, we're not feeling it as much in the US, or at least I haven't really seen good figures on gas consumption and how that has changed since the end of February. But but elsewhere in the world, you are seeing, kids don't go to school, people work from home. There's all sorts of other restrictions on the times that companies are even available and online to be using energy resources. So things like that are happening, which is actually shrinking demand. That again, I don't think we're seeing that much in the U.S. from what I can see.
Thank you. And we have this is probably our last question given the timing. And the question is, what about the AI centers and what effect will there be on the climate with regard to the AI centers?
Yeah, at data centers. Yeah, it is it's somewhat frightening. I was reading a story about in the regions close to Virginia where it's actually warming. I mean, the the air is warmer in these places close to the data centers, which is obviously ecologically a real challenge for the ecosystem. Um, yeah, there has been a lot of pushback on data center construction. There is, definitely, shortages of energy or energy needs, and energy sourcing is a real problem. Um, so there could, things that I've read and seen is that we could see some delays in those projects. And again, you think about some of these other ideas that seem well, literally space age, like putting data centers on Mars or something like that, whether we again eventually get to those solutions. But I think those are very real concerns, and clearly citizens are, certainly visibly and notably and justifiably upset that the data centers are making these inroads, coming into those communities, and increasing energy costs for consumers. I mean, I think the governors and people in these areas are well aware of how this is moving and how it is potentially affecting consumers, and in some cases it is the hyperscalers themselves that are having to pay for any of those increases so that the consumers don't have to absorb those increased costs. So I'm sorry I don't have a great answer for that, other than it is very, very challenging and something that indeed needs to be worked through. Thank you everyone for the questions, by the way. I appreciate the opportunity.
Thank you, Jennifer, for your presentation.
Thank you.
And that concludes our first day. We will continue with our second day tomorrow, 11 a.m. Central. Thank you for joining us today and hope to see you tomorrow.
Thank you.
Thank you. Bye.